Hello everyone and welcome to the Tortoise channel. My name is Eduardo, for those of you who don't know me, and I decided to create this channel to provide more financial education when it comes to stock market investing. And I'm a big believer in the principles and the framework that was laid out by Warren Buffett and his mentor Ben Graham, as well as Charlie Munger and other ones that follow them. But in this, of course, what's called value investing has been proven many times to outperform over time, and it really resonates with my personal temperament and all of that. So I do. It's a strategy that I definitely that I'm a big advocate of here on this channel, and that's how I intend to continue to make a lot of money. So why am I recording this video? First of all, I want to say big thank you to all of you who have subscribed to the channel or who have been sharing the channel with people that you know that are passionate like me, passionate about the markets and all things investing, because I can see that the number of subscribers have been just growing a lot over the past 2 weeks, which means that you find value in whatever it is that I'm sharing. So I definitely appreciate that. And as a sign of appreciation, today's video is going to revolve around the valuation methods that I use when it comes to putting a value on a company. And this follows on from a few comments made by some of you where I don't remember the names, of course, apologies for that. But one of you asked me to create a video to discuss my valuation framework in how I go about putting values on companies, right? So this is what we are going to do. And I will be using two examples, namely Alibaba and LVMH, my first and my second largest portfolio position. So I think because they are different businesses growing at different rates, then you can have a clearer understanding of how you should adjust your evaluation methods based on what company you are analyzing. So, but first, let's take a step back and let's provide some context here. When I say putting a value on a company, the reason I want to put a value on a company, guys, is because I never buy anything without a margin of safety. And you already know that, right? So if I determine that the intrinsic value is $200 per share, I will only buy with a 50% margin of safety. That's how conservative I am. And the reason for that is because I want my downside to be minimal and I want my upside to be exponential. So in other words, I want to stack the odds in my favor. In this way, I can do that. So when it comes to the importance of valuation, by the way, I put together this PowerPoint here, which is something that I use with my students as well, with our partners. I don't call them clients because we are all in the same journey together. But this is what I use to get across some of these concepts that we discuss here, that we are going to discuss today, okay? So there are many valuation methods, but you can see that some of the most important ones include comparable company analysis and discounted cash flow, DCF. I use both. So comparable company analysis, that includes the ratios that you will be using when comparing companies in the same industry, and even companies across even companies in other industries, they will have different characteristics. So some ratios are adequate to some of them and completely useless to others. And so that's why a comparable company analysis can help you a lot to compare companies, because it gives a company's relative value, how much it should be worth based on how it compares to other companies. And ratios that go a long way in determining that will include, for example, the PE, the price to book ratio, the price to free cash flow, and they will vary based on the stage of growth the stage of growth of the company. If it's an early stage company, then probably it's unprofitable, right? Because it's growing very fast. Maybe it doesn't make any money. And so you are not going to use the valuation like the PE. It doesn't make any sense, right? You would probably use the price to sales. The same happens, for example, The same rationale applies to a company that has matured, that pays a dividend. It's growing slowly. So will it make sense to evaluate the same way as you would with an early stage company? Of course not. So this is like a comparable table, as you can see, just to give you some example. But I'm just flying through the slides instead of discussing them in greater length, because what I want to get at is really the core valuation methods that I use, and that includes Phil Town's valuation methods that are the margin of safety, the payback time, and the 10 cap rate. And then I like to combine that with the reverse DCF. Okay, that's it. But of course, comparable ratios are very important, and I also use them as a complement to my framework, right? So let's discuss Phil Town's valuation methods now that you understand why why valuation is part of the process of analyzing a business. Of course, remember that the real value of a company is always based on its future cash flows, and then we have to discount those cash flows to the present, right, to determine the value of that company. That's essentially it, right? And so I took Phil Town's virtual investing workshop about 5 years ago, and it was very, very insightful. I managed to learn a lot, and to this day, I still apply his 3 valuation methods, as I will be delving deeper into over the next minutes. And so you can see that these valuation methods include the margin of safety price, the payback time, and the 10 cap rate, and they are discussed in his 3 books. So the rule number 1, which was his first book, discusses the margin of safety method. The payback time discusses the payback time method, as it's already implied in the name. And then Investor talks about the 10 cap rate. So if you haven't yet, I do recommend reading these 3 books. I don't have any partnership or affiliation, but I really, whenever someone asks me, hey, can you tell me great books on investing? These are the ones that immediately come to my mind. All right, they really help me a lot. And so let's start with margin of safety, and I will walk you through each of them from a theoretical standpoint, and then we jump into practice. The purpose of the margin of safety, guys, is remember that all of these methods have a margin of safety built into them. Okay, so it's not because this is called margin of safety and the other one is called payback time that the payback time doesn't have a margin of safety. No, they all do have, but they all use different metrics, as we will see. So the margin of safety, this is that once we know what the business is worth, we want to buy it for half price, which is 50% of its intrinsic value. By buying businesses with a big margin of safety, we are already accounting for Mr. Taleb's black swans. Black swans, if you haven't read this book, black swans include the unknown, the unpredictable. So something that is unexpected that can cause a lot of volatility in the stock market, both to the upside and downside, like COVID, for example. And so by buying with a margin of safety, you are already accounting for all these uncertainties and unexpected events. This will potentially allow us to increase our rates of return and with much lower risk. Yeah, okay, very important. And then we have payback time, which tells us how long it will take us to get our money back if we bought the whole business and pocketed all the earnings. Once we get our money out of the business, we have no risk because we are playing with the house money. Okay, so payback time helps us think as a business owner. If I buy this whole company, how long will it take me to get my money out of the business, typically from free cash flows, but it can also be from earnings, to recoup all my investment. Yeah, and typically what we want to get our money out in about 8 years or less, because this is what happens in private equity. And so we are buying publicly traded companies at private equity prices. And that means a significant margin of safety, because in private equity, we don't expect to sell a company with a high degree of liquidity. And that's why buyers demand a faster return. Otherwise, they wouldn't buy it. They don't want to pay more more for the business than a few years worth of earnings, which is typically 8 years. Okay, and then of course we will compare the margin of safety price with the payback time and choose the lower figure. Now, 10 cap rate. This was adapted from real estate. When buying real estate, investors like to get at least a 10% return on the purchase price of the real estate after deducting all the expenses. And that means a 10% capitalization rate on the money paid. And so to get a similar, to apply that method to the stock market, the first thing we have to do is we need to determine the company's owners' earnings, our earnings as shareholders. Okay, and so we start with the operating cash flow, we add the tax provision, and we subtract the maintenance capital expenditures. And then we calculate the cap rate. And to do that, all we do is we divide the owner's earnings by the market capitalization. And what this means is that typically undervalued companies will have a cap rate of 10% or more. Okay? And that's a sign of undervaluation. But remember that most companies are undervalued because they are crap. All right? So, because we focus on quality as well as valuation, we need to assess both sides. All right. So, guys, I hope this is clear. And now I just want to show you something else here that you may find, in fact, you will find useful, is that when should we use the margin of safety and the other methods? The margin of safety is best for companies that are growing at really fast rates. So it doesn't, when to use it, is based on a company's earning. It works best for high growth companies that are growing at 15% or more per year. Then this is when the margin of safety is more suitable. Okay. Which means that companies that are growing at 6, 7%, what happens is you will notice that the margin of safety is too small, and the company is well above, will probably likely, in all likelihood, never get to those levels. Right? It's very unrealistic, and the reason for that is because they grow smaller. They grow slower, and so the margin of safety, and I will show you the examples, is not adequate. Then we have the payback time, and we are focusing on free cash flow per share. If the company invests a lot of its cash flows into growth, then the free cash flow per share is not really a good metric to use. Remember that some companies may even have negative free cash flow because they are reinvesting everything into growth. That doesn't mean the business is not great, but this metric here is not suitable. So you could use net income, or you can also use operating cash flows. Okay. So when should we use it? You already know why we use it. So when do we use it? Payback time is based on free cash flow generation, making it ideal for companies that produce strong cash flows without necessarily growing rapidly. For example, Nike is certainly one of them. Alibaba was one of them not that long ago, but now they are really really growing a bit faster, which is good. And the same goes for PayPal. But still, PayPal is still growing well below 15%, if I'm not mistaken. I'm talking about free cash flow generation. So this is something we have to pay attention to. Okay, but and last but not least, the 10 cap rate owner's earnings. You can see that the 10 cap rate works best for mature companies, established businesses. like, for example, dividend aristocrats, and Nike is one of them, okay? One of the things that we do is you calculate all these three metrics for every company, and then you compare those metrics. And yeah, so now that you know the theory, let's start putting everything into practice. So I have LVMH right here, as you can see, and I already, so the numbers already reflect trailing 12 months numbers. So this is all updated, but I'm just going to walk you through. The numbers. See if okay. Now my face. You are seeing my face. Cool. So what I have here, guys, is I have the big five numbers here. These are the big five numbers for LVMH. Why is this important? Because it shows me the track record of the company. How much growth has the company generated over the past 10 and 5 years? I start with Royce because Royce shows us how effectively the company generates net operating profits after tax on its invested capital, right? So it's a measure of capital. It shows us the effectiveness of management at allocating capital and generating profits. Very important, right? Ideally, I like to see this well above 10% or at 10%. That is certainly the case for wide moat LVMH. And then you can see the top growth rates: book value per share, earnings per share, sales growth rate or revenue growth rate, and operating cash flow per share. And you can see that across almost all of them. Well, the company has grown at least 10% in terms of book value and operating cash flow per share. Earnings per share were a bit lower, the 5 and 10 year metrics. And the same goes for sales growth, which has decelerated over the last 5 years, but not a big deceleration. And now let's start with the metrics. So first of all, with the method, First of all, we have margin of safety. How do we go about calculating the margin of safety method for any company? We start with the earnings per share. And if I go to LVMH, which is right here, you can see that the company's earnings per share sits at 22. That's the number that I will use right here. And then you wanna have a look at what analysts are saying in terms of this company's growth going forward. And unfortunately, for this business, the analysts are not giving me anything. LVMH, let me see here. Maybe I can find something. No, nothing. So I have to go to another platform. Let's try FinChat. Okay, let's try FinChat. See if I can find it. LVMH right here, and we want to see exactly the growth rate that analysts are projecting going forward, and you can see that it sits about 10%. Okay, so 10% is what analysts are estimating, but you can see I like to look at prioritize book value per share because, as I mentioned right here in the comments that I made against this cell, you can see that book value per share is the hardest to manipulate. And so I like to use this metric instead of earnings per share, but that's okay because they are practically in line, even though earnings per share is a bit lower, but I'm going to use 10%. I'm going to use 10%, which I think is conservative. And then for the default PE, you're going to double. The default PE will be twice the growth rate. It will be twice the growth rate. So 10 times 2, we are using 2, that is going to be 20. The thing is, you have to compare it with historical PE. And over the last 10 years, LVMH PE has hovered around 26. So it's very unrealistic to use a PE of 20, right? So let's up that a bit. And I'm already being conservative because this has historically been a premium company. So I'm going to use 23 here. 23, and then to calculate the estimated future earnings per share, what are we going to do? let's get our compounded annual growth calculator. Okay, we're going to put 22 right here. We're going to assume our 10% growth over time. And if we use 10 years, we can see that 22 becomes 57.06. That's the number we're going to put here. And now we have a future earnings per share. We multiply the future earnings per share by our P, which is going to be 23. And if we do that, we get a future earnings per share. We get a future price of 1,311. So this is the price, according to our assumptions, this is likely to be the price per share of LVMH in 10 years' time. But this needs to be discounted to today, right? And because I want a 15% annual rate of return on my money, what you can do, because that means in 10 years you're going to get two doubles, right? Because at 15% your money doubles every 4.8 years, so you get about two doubles in 10 years. You are going to divide this number by 4 to get the company's intrinsic value, which sits at about 327. And because we never pay intrinsic value, we want to buy it with the 50% margin of safety. That means your most price is 327 divided by 2, boom, 163. Is that realistic? The answer is no, because 163 is very low for a company like LVMH, which is trading at 533, and this is already at 40% below its all-time highs. Okay, and so the margin of safety again is most suited for companies that are growing at 15% per year or above, because that will mean a PE of about 30. So another thing that I could do is I could increase the default PE, right? I could, instead of 23, I could put 30. But this is what I did, and gave me this number. Okay. Now, payback time. How long it takes us to get our money back if we buy the whole company? So we have the last free cash flows, last year's free cash flows. If you go to financials, cash flows trailing 12 months, you have the free cash flow right here. Okay, that's right here. And then what I'm going to do is I'm going to grow the free cash flows at 10% per year over 8 years. Okay, and then I'm going to sum up all those cash flows and I get 190. And if you divide the 190 billion, and if you divide this 190 billion by the number of outstanding shares, you are going to get a price per share of 382. In other words, if the company ever drops to 380, right? And if the company ever drops to 380, well, another way of explaining it, if you want to take our money out of the business in about 8 years' time, right? Assuming the company can grow at 10% per year, the price you should pay per share should be around $380 to 380 euros per share. Okay, and you can do the same for net income. So instead of using free cash flows, we're going to use net income, which is lower than free cash flows, which is something that I like, because it means the company is very good at converting cash, at converting earnings into cash. But you can see that if we grow that like we did for free cash flows, then we sum all the money, right, and then divide it by the number of outstanding shares, and we get 277 euros per share. Okay, and last but not least, we are going to calculate the 10 cap rate. And this means we start with operating cash flow. We already have our total capex. Maintenance capex is usually about 10% of total capex. So if you don't see the company addressing maintenance capex in its financial statements, you can just use 70% as of capex, which equates to the maintenance capex. And what does this mean for those of you who don't know the difference? Total capex includes maintenance capex, which is how much the company is spending to maintain its current operations, and growth capex, how much the company is using to grow the business. Okay, and so we want to subtract maintenance, the maintenance part of the total capex, and then we add the tax provision. As you can see, a tax provision is the estimated amount of income tax that the company is legally expected to pay to the IRS for the current year, but they haven't paid that yet. And so we are going to add the tax provision, and we get our total owner earnings. Operating cash flow minus maintenance capex plus tax provision, boom, we get our total owner earnings. And then what you do, as you saw here, you do your owner earnings by market capitalization, and this should be lower than 10%. Yeah, or 10%. Another way of doing it is like the way I do it here. You divide total earnings by the number of outstanding shares. That's 43. And then if you multiply 43 by 10, you get a price per share of 430, which means that at 430 euros per share, the company was already trading at a significant discount. And remember that the 10 cap rate is likely to be the most conservative method because it doesn't include any growth assumptions, unlike the margin of safety and the payback time. Okay, so it's about 430. And at one point, if I go here to Toro to show you LVMH, you can see that I bought the company not that far from those levels. So my average price is about 450. So I was already buying the company with around the 10 cap rate level, all right, which has again a 50% margin of safety included. Okay, just like the payback time and the intrinsic value in the margin of safety price, which means, let's assume, so you based on the payback time and the 10 cap rate, we already excluded the margin of safety because it's best suited for higher growth companies. But you can see that the payback time and the 10 cap rate give you similar numbers. So we can say that about $400 is already a very nice $400. If you multiply, 400 euros. If you multiply 400 by 2, that means the intrinsic value of LVMH sits at around 800 euros per share. So for those of you who want to buy LVMH at current levels, this could be a consideration, yeah. However, I wouldn't do so because I don't have my 50% margin of safety, and I don't care how great the business is, I will always do that. Okay, so and last but not least, another method that I use, is the DCF, reverse DCF, which shows what is currently built into the stock price in terms of growth assumptions. And you can see that, what's this? Let me go back, hold on. Very sorry for that. Okay, so let me go back here. Why is this? Don't know why this. It's blurry. Okay, bear with me 1 second. Here we go. I think I'm still recording. Yes. Okay, so this is let's go here to LVMH so I continue my thought process. And you can see that the current stock price is about 533. Shares outstanding, perpetuity growth rate. My desired return is always 15%, and this is free cash flow in year 1, which is the same that we had right here, of course. And now what we're going to do is we are going to grow these cash flows at our projected 10% growth over time. And you can see, in fact, that was I was projecting, right? Our growth was, about 10%. And you can see that about 370 is the price that you should pay, which is, again, similar to what the payback time is in the 10 rate. Okay. Now, the stock is currently trading at 529. So the stock market is currently reflecting higher, the price is currently reflecting higher growth rates. In fact, if I change this now to about 16.5%, you can see that you get your current price of 535, which means that investors are pricing LVMH as though its free cash flows are going to grow at 16.50% per year over the next 10 years, which I think is a bit of a stretch, and that's part of the reason why we are already well off my margin of safety price. Because if you look at what they did in the past in terms of operating cash flows, for example, they only grew at 14 and 10%. Okay. And now let's cover Alibaba. I'm sorry, I know the video is extended, but I want to give you as much value as possible. So this one is going to be faster because we've already laid the foundation and you already understand the numbers by this point. And so starting with current earnings per share, you can see that current earnings per share currently sit at 8.62. That's the number I have here. I already know that analysts are estimating about 9% growth going forward. This is the long-term estimates, okay? But and you can see that the numbers don't look as good as LVMH's. That's just the reality. So, for example, I don't like the fact that operating cash flow has been negative, compounded at negative -1 over the last 5 years. Likewise, I don't like the fact that many of these numbers are below my preferred 10% growth rate. But still, I bought the company with such a deep margin of safety and I really was attracted by this story. Because they were involved in AI, cloud computing, and also e-commerce, so multiple levers. And when I bought the company, remember, at an average price of about $80 per share, they were trading almost at book value. Book value at the time was about 50, and I was buying the company at 60 all the way up to 70. This was the market was pricing the company as only the company. So how can I say? The market was pricing the company as though the company was not going to be able to grow, not even 1% going forward, which in my opinion is ridiculous. Okay, and so I bought the hell out of the stock. But yeah, so a conservative number, I used 13%. If you look at the 10-year earnings per share, that's about 14. Book value 22. It's significantly slowed down, but I'm going to use 13%. Default PE 26. The historical PE is about 32. I'm happy with 26 because 32 is I don't know if Alibaba, I believe it will, but to get that average level, I don't think Alibaba will be able to achieve that average over the next 10 years. So I'm lowering my default PE. So I'm using 26. And now if we grow 8.62 at our projected 13% per year, we get a future earnings per share of 29.26. And if you multiply this by the default PE of 26, you get the future price of $760 per share. What do we do now? Now you have to discount this back to the present. So divide it by 4 and we get an intrinsic value of 190, and that is Alibaba's intrinsic value according to the margin of safety, which means with the stock currently at 167, we are still below what I think to be its real value based on this metric. Okay, and then if you divide the intrinsic value by 2, this means that according to this metric, you will pay no more than $100 per share. Again, because this happens because we are using lower growth rates, and so it's not the best method for this company, right? Maybe Alibaba can go back down to 95, 100. I personally don't think so. We never know, but this is not realistic, if you ask me. So let's use the other two methods. And if we use payback time, I used operating cash flows because Alibaba has been reinvesting a lot into growth, as you know, if you have been following the company. You can see that if I look at the free cash flows, look at this, they took a beating, right? Because they are investing a lot into growth, spending a lot of money on data centers and on the AI to join the AI boom. And so I used operating cash flows and also earnings. And if I do that, let's grow the operating cash flows at 13% over 80 years. This is the cumulative free cash flows. If you divide this by the number of outstanding shares, that gives you an average price per share of 127. And if you do the same for earnings, you get 125. Look how close they are. That means I like that as well, because it means there is little manipulation. Okay. So this means that if Alibaba grows operating cash flows and earnings at 13% per year, then we should be able to recoup all our money in 8 years, both from operating cash flows and earnings, if we buy it at around 127. The stock is higher, and so I wouldn't be buying at these levels. And now, last but not least, we have yet discussed the reverse DCF, but this 10 cap rate, operating cash flow, subtract maintenance capex, and this do the same that we did for LVMH, and this gives you an owner earnings of 57. Why is the owner earnings so low? Guys, because if I go here, your operating cash flows have declined substantially. Let me flip this to the annual screen. They have declined as well, because you can see that the company has been reinvesting a lot into growth, and part of that has led to this collapse that you can see. So it's just what it is. And so you can see that it wouldn't make sense for us to give too much emphasis to the operating cash flow, if you ask me, because it's inaccurate, right? So do you think Alibaba will ever go to 57? I mean, it doesn't make sense, right? Also, you have to think the company is investing a lot into growth, but in all fairness, that's cash that the company decides to put to work. But they could have more of that cash, and that will definitely increase the 10 cap rate. And so, per my understanding, if you want to buy the company with a big margin of safety, look at the margin of safety price 95, and you can see that the operating cash flow is about 127. Anything between 127 and 95 should be solid, but I would be gladly buying shares at 127 already with a significant margin of safety. Okay, you look at the reverse discounted cash flow. Let's say I'm using net income here. Let's say the company can grow at our projected 13%. You can see that the price you should pay is about 123. Okay, so with the stock currently at 162, if I change this to 15%, no, so 17%, it's even higher, about 18%. Okay, so the market is pricing Alibaba as though its free cash flows are going to grow at 18% per year, which for me is definitely a very optimistic. And so I wouldn't be buying shares at these levels, okay? Even though we haven't reached our intrinsic value, but I want a 50% margin of safety once again. So look, this is pretty much what I do. And if you compound, look, we've been compounding money at about 25%. And I'm not sure, I'm not saying that's going to be the case, right? Compounding money at 29% is fantastic. That's been our record since inception. But even if we want, because our minimum acceptable rate of return is always 15%. So if we can grow this money without putting any more money to work, you can see the wonders that this will do to this portfolio. Okay, and that's the journey that I'm currently in. So thank you all. I hope you liked the video. I'm sorry it was a bit extended, but I just try to provide as much value as possible. And if you liked it, then by all means, try to share it with your friends or people who love the markets, families, family as well. And leave a comment as well, because that really goes a long way in incentivizing me to put more content out, because at the end of the day, we are all walking the same journey. Okay, so yeah, stay tuned for more, guys. Thank you so much.